a lot of people have made a lot of money in real estate, right?
Yeah.
And so people are always asking questions about how they can too.
Yes.
And I think one of the best answers is getting creative, just figuring it out. It can be done. So, keeping your mind open, keeping your options open, and being willing to do some kind of creative things, including creative financing.
Yes.
So we've got Nicole Rueth here from the Rueth team with Movement Mortgage. And she is going to talk with us today and help us understand what some of the creative financing strategies are for people. So thanks for being here.
I love this time together. Thank you.
Yeah.
Yeah.
So I guess the first question is, if somebody's trying to buy and sell at the same time, what kinds of strategies could they use to just make sure that that's all going smoothly?
Yes. So I remember a time when nobody had to deal with this. Didn't it feel like everybody just sold their home and they bought a new home and they closed on the same day?
Yes, and we called them domino closings.
Yes.
And everybody, there was like always a string of closings that were all dependent on like the first person to close so that everyone else could close.
But they all closed that way.
Yeah.
I don't remember ever talking about buy before you sell programs before. Somehow nobody can seem to figure out closing dates anymore. And nobody wants to move until they find the right house, right? So it's like, do I put my house on the market? Do I find the right home? And there's more inventory, but it feels like there's less inventory because there's less of the desirable inventory. So homeowners really do struggle with this because I don't want to give up what I know, the low interest rate that I have, the home that I have. It might not be the right home, might be too small, too big, not in the right location, but I don't want to give it up and go change for something that is going to cost me more because of home prices have gone up. But until I know for sure that it's the right one. So coming up with creative strategies to say, look, in order to create less stress, let's figure out what is the financing solution to get you into that home and then perfectly stage and price and list this home to get the most money for it.
And isn't that nice too? Because if you can get out of your home and into the new one, you don't have to deal with showings, and you can, like you said, you can stage it really nicely. Which, the stagers will tell you can sell it for more money and more quickly if it's staged nicely. But yeah, not dealing with showings, all of those things are great reasons to move first and then sell.
And a lot of people, I don't know if you've felt this. I feel like a lot of people have a lot of life going on right now. Like there's rarely anybody that I talk to that doesn't say it's just a lot, right? The stress, the pressure, the whatever. It's just, life is just a lot. And so if you can just remove that one thing, but oftentimes for many people, removing the stress of having to move twice often comes at a cost. And so what we try to do is look at creative financing solutions in kind of a spectrum of answers. It's like, okay, here's the least expensive answers, depending on what you can afford. And here goes to the most expensive answers and solutions. And I usually kind of say, okay, there's 5 solutions we could choose from, give or take on the situation. And I'm going to start with this one, and we're going to work our way up. So oftentimes, if somebody has the income that they can afford to make that move, and maybe they don't have a mortgage on this existing home anymore, that makes it easier. Or maybe they have a mortgage, but it's low, and they make enough money to be able to afford both homes, or they have an ability to get a gift, cash out equities. They have a lot of money in savings. They could put a large down payment. So we have a lot of choices if somebody's strong financially.
Oh, well, and 401k loans, that would be another example. Yeah.
You know what the beauty of 401k loans is you don't have to count it against the debt to income ratio
Oh, I didn't know that.
because you're borrowing from yourself. Right?
Yep.
So it's one of those loans, because we talked about at a different sitting, we talked about bridge loans, and now you have to qualify for all the things, and you don't have to do that with a 401k loan. So it's kind of it's a really fantastic solution. That and gifts. So if there's somebody that could give you a gift, even if you pay it back after closing, I don't want to know about it as
Tell
a
your
lender.
lender about that. Yeah.
But that could be another way, right?
Yeah.
Because then I don't have something counting against your debt to income ratio. But the ability to do that. But so we have bridge loans that we could do so that we could tap into the equity and get you in. If you already have a HELOC, I suggest that if you have a home today, even if you're not thinking about moving, get a home equity line of credit against your home. I have one on several of the homes I own because I love the idea that I have tappable equity that's available to me should I need it, and you don't have to pay on it if you haven't withdrawn the funds. So I think there's like a $75 annual fee on them, and so I just love having that access.
That's just in case.
So if somebody decides that they want to move, then they just tap into a home equity line of credit that they already have. I love it when they say, yes, I have one. And I'm like, oh, bonus.
What about buy before you sell loans?
Yes.
I had not heard of those before.
So they're becoming much more popular because of the fact that we don't have as many clients, especially as home prices continue to go up, that can afford their existing home and the new home. Oftentimes, the new home is going to cost more than, even if somebody's downsizing, it could be that the new home costs more than the existing home. And so be able to qualify with both of those mortgages is challenging. So a buy before you sell is allowing me as a lender to not use the current mortgage on the current home against your debt to income ratio. So we'll just play this out. There's a handful of companies out there. And so say there's a company out there that has a buy before you sell program. They're an independent company that is willing to take a risk to write a contract offer. Say you're about to sell your home, but you don't want to sell it yet. You want to go buy the new home, then you want to stage it before you list it. So it's not listed, it's not on the market yet, so I can't do a bridge loan. So a buy before you sell company's going to come in and they're going to offer you a contract, a non-contingent, fully written contract with a 6-month closing date.
Oh.
Yes.
Interesting.
So the goal is they don't want to close on that contract, but they're going to give you a fully executed contract, non-contingent, so that I, as a lender, can go into jumbo guidelines, Fannie Mae and Freddie Mac guidelines that say that as long as I have a fully executed contract, non-contingent, that I can exclude that debt from your debt to income ratio.
So how much does something like that cost?
It does indeed. It comes with a risk because in 6 months, that company could be owning your home. Or helping you accelerate the sale of that home. And they're not in the business of owning homes, as you can imagine. So it could cost a couple points, anywhere from 1 point to, I've seen it as high as 5 points. And a point is 1%.
Right.
And so it can either be a percent of the loan amount or a percent of the home price.
The price.
Yes. Yeah. So oftentimes it does come from the equity. So I tell people that they've gained a lot of equity over the last handful of years. Maybe not the last couple, but certainly the years up into and including the pandemic years. They've gained a lot of equity. There is a cost to stress. There is a cost to removing stress.
There's a cost for convenience, yes.
So what is that cost to you? And knowing that it comes out of the equity in your home, not out of your pocket, then that might be worth it to you. So we absolutely look at those. And then what happens is they can give you some of the equity from the home. So they can put a contract offer so I don't have to include it in the debt to income ratio. They can also give you funds from the equity of your home so that you can go put those funds to use and use it as a down payment on the new home.
Oh, interesting.
So now I've got the down payment. Now I've excluded this. I can afford that home. And now the company is working with you as an agent to sell that home as quickly as possible.
Yeah. Interesting. Well, now I know we're talking about creative lending things, but also the PCOA, right? The post-close occupancy agreement or the seller rent back.
Yeah.
That's another option for homeowners to get their house sold, get it under contract, and then start shopping. But they stay in their house, so they rent their house back from their buyer or the new owner for a period of time, up to 60 days. While they shop for their new house and close on the new one. But they already have their down payment, all the seller net proceeds from their sale sitting in their account because they already closed, but they just haven't moved yet. So that can be a good option too.
It can, because it makes you a cash buyer or at least a more liquid buyer.
Yeah, more liquid for sure. What kind of programs? So, 2008, they got rid of a ton of different programs, lending programs, right?
Yes.
And we've seen some of those coming back. And so I think it's worth mentioning, what loan programs are available right now, like for people who are self-employed borrowers or investors, people with inconsistent income, not your typical salary W-2 employee.
Yes.
What are the different types of loans that they could use?
So before 2008, they were called subprime, right?
Mhm.
Now they're called non-QM. It does have a new title.
Yes.
It is more restrictive. If you look at the loan availability, it is definitely more restrictive than it was back then. But those non-QM, so non-qualified mortgage is what that stands for. And a qualified mortgage is what's regulated and what you think about when you think about Fannie Mae and Freddie Mac and more in the box vanilla lending. So a non-qualified mortgage would be everything from your bank statement loans to, we have the first, and they kind of go in this order, higher interest rates.
Yes.
So asset-based is your first option. So if you've got a lot of assets, you have $500,000 in an account, you've got $1 million in retirement. So if you've got different accounts that have, or investment accounts that have assets, then I can use it. Really anything over $500,000, I can use that. Fannie Mae and Freddie Mac allow me to use some of the assets, and those that they don't, the non-QM products do. So an asset depletion loan is your first go-to. Then I would be looking at bank statement loans. So I'd take 12 months or 12 or 24 months of personal or business. So I have some options there, different levers I can choose. And so I'm going to take all of those bank statements. We're going to upload them to a system that's going to calculate all of the deposits and determine what an average income that you're bringing in. Bank statements. And then we might look at a P&L loan. So it's based on a profit and loss of your business. Because clearly I'm not using tax returns because I'd be a full doc loan. And then you might go into a no ratio or a DSCR. So a no ratio is no income whatsoever. I don't even put the fact that you're employed on the application. And so you just have to have enough money down and enough in reserves. So no ratio is for a primary home and DSCR is for an investment
homes. Yeah, let's talk about those DSCR loans because I feel like that's been, I don't know, a lot of people have been talking about it lately, but I think very few people really understand what they are. So I know it's debt service coverage ratio, right? And so let me just see if I've got it here. So
Perfect.
So it's for an investor who is looking to rent out the home. And so when you calculate their mortgage payment, the interest, the property taxes, and the insurance,
Yes.
Whatever that number is, the estimated rent payment that they would get from that property needs to be like 1.15 times higher than what that mortgage payment is, right? So if you can demonstrate that the rent will more than cover the mortgage and all of those things that go with the mortgage payment, that is the DSCR loan.
Yes. So we actually have programs where it goes all the way to a 0.85%. So the rent can actually be slightly under.
Oh.
Yes. You're going to need more down and your interest rate's going to be higher.
Of course.
Right?
Yes.
Yes. So more risk. So the higher the rent compared to the mortgage payment is definitely going to be in your favor for all things. But as we're looking at the DSCR, it's based on what the appraiser determines the market rent to be or what the current rents are. So if it's currently being leased, that can hurt you. Because a lot of times if a landlord is selling a rental property,
they're not at market rate. Yeah.
Exactly. Yeah. They probably haven't raised the rents in a while. Yeah. So it's going to be the lower of the two.
Okay.
Yeah.
All right. If you like this content and want to support the channel, don't forget to hit the like, subscribe, and alert bells before you go.